So, hey, thank you for coming today. So first off, I'll do a little intro on like myself and models I provide and those sort of things. The goal for today is really talk about how to build a basic financial model and like using SaaS as an example. That was the original idea. However, I am totally happy to like take a poll of like what different people's business models are and get an idea of like how we should adjust the content to it. So my goal was to go through a little intro in terms of like how to do models and then pull open a model and talk about the components of the model that matter and how to kind of think about that. But we can adjust the types of business models or the types of components to it that make sense that are useful for it. Just as a heads up, when I share my screen, I can't really see the chat. So, or can I?
I will narrate the chat. It'll be fabulous.
Yeah, I just don't see an option. I don't know if there's an option to downsize it, and I don't want to.
So let me give you the three companies that we have. We have Pearl, which is the Plaid of retail data. We have Josh, who's with, like I said, comp science, bringing workplace accidents to zero with the next generation of workers' comp bundled with our video analytics powered safety software. And we have Mike with CoLearn, which is a virtual education platform. So there's the context. Let's do it.
And correct me if I'm wrong, but all of those sound like SaaS, enterprise SaaS style businesses. Is that correct?
That is my understanding as well. If you're not an enterprise. Well, cool. Well, Mike, I assume actually since, he's paid consumer, high pay consumer. Mike's the high pay consumer.
Yeah, well, which is pretty close. Like that's the way you do high level consumer and B2B SaaS is the same until you get to high ticket SaaS enterprise and do it a little bit differently. So that's totally fine.
28K account size per customer per year.
Yeah, well, we can talk about what the parts of it that matter. So so based on me, so I'm Taylor. I did my bachelor's of economics at University of Virginia. I did my MBA in finance at Tepper School of Business at Carnegie Mellon in Pittsburgh, and I actually live in Pittsburgh currently. I've run Foresight for the past 5 years. I've done it part-time for about a decade prior to that. Along the way, I've done a bunch of other things. Used to work as a VC, was a entrepreneur residence or investor in residence at Venture for America in New York. Worked as a VC in New York. Do a fair amount of angel investing. Run forecasting product and e-commerce company. Worked as a strategy consultant. Used to work as a professional photographer. Used to do innovation and financial services for like other big companies. So done a bunch of different things. Foresight itself is what I like to call like a boutique product and services agency where I focus on building financial modeling and forecasting for startups and venture funds. And mostly work with startups from like pre-seed through B stage, and venture funds, usually emerging managers through the first like 2 funds. And so most of what I do is with startups. Now, I've done financial modeling basically my entire career, and I do it. I believe in it because I think models can be used to help us make critical business decisions, even if they're not accurate. And the thing about models is people will say, oh, they're not right, they're not useful. And my counter to that is, no, they're not right, but that's actually not the part about that's not the part about a model that's useful. The part that's useful about a model is having a tool to do analysis, actually think about the business, not so the actual kind of results itself. All the models we're building, there's no way for us to forecast the future, at least for the majority of what we're trying to forecast. There's no way. We're trying to take immature businesses to forecast discontinuous changes in the future. There's no way we can create a forecast which is going to be accurate. So being accurate is the wrong goal. The right goal is thinking about your business and creating scenarios and situations, kind of understand it. And so that's the kind of my lens to thinking about kind of financial models. Now, on my website, I do a fair amount of just templates as well as kind of services. So this is my website. You can check out models. I think a few of you already kind of know them. What we'll talk more about today is 2 templates. I'll probably bring up both of them. We'll do like a little screen share and talk about components of models that are useful and use these as ways to use them as examples to talk about how to do a model. So there's kind of 2 tools we'll probably kind of focus on here. One is the runway and cash budget tool. The other one is the SaaS forecasting tool. Both of them are free. The runway and cash tool is mainly used as it can create a revenue forecast, but primarily as a expense budgeting, cash flow forecast, financial statements for like early stage companies, like a minimum viable model to be able to use to fundraise from people like Hustle Fund and kind of beyond. And then the SaaS forecasting tool is focused strictly on the revenue generating side for like a SaaS business. And we'll use as an example to talk about the components of SaaS. Both are free. You can download them. They're cool. And we'll bring up the SaaS one in a second.
Oh, by the way, we have 2 new joiners, Roshni and Drew. You could tell us a little bit about your company, that'd be great. Drew, I can tell you about his company. It's Fixable. It's B2C, but think of it as like Cameo for construction, like at-home construction projects, right? Like getting instant, like tele-construction help.
Cool.
Sorry, keep going. I'm gonna shut up now.
No, that's fine. Try to figure out how to use.
Keep going.
So the core thing to think about modeling I try to think like the core part, like, so okay, let's take a step back. Building a model for an early stage company, people often get way too focused on revenues. Now, the key to kind of building an early stage model is usually not about doing a revenue forecast. Most times when you're trying to convince early stage investor or someone like Will, creating a revenue forecast is not going to really do much. Please correct me if I'm putting words in your mouth, Will. But usually, if you're trying to convince someone like Will, you're building a big business, creating a revenue forecast to support that is usually not the best way to do it. So the way I like to think about, would that be fair, Will? Is that correct?
Pretty sweet, yeah.
So what I tend to think about is let's think about the model in a couple components. The first one is people often use a revenue forecast as a way to convince someone building a big business. But the problem is that it kind of combines a couple underlying trends. One is how well can you execute the growth of the company, and then secondly, what are the underlying unit economics of the business? And so the problem is if you condense the two of them to create this like hockey stick of growth, it's really hard for someone to kind of understand actually what's going on underlying in the business. It's hard to have a conversation around that. Usually at pre-seed stage, even the business model itself is fairly immature. You don't really even know like what the right business model is going to be. So usually the best way to convince an early stage investor that you have a potential to build a big business is, one, to convince them of market size, that you're selling into a large market. Then two, probably give them some idea that there is some basic unit economics that will work, right? Meaning that you can provide a product that you're going to sell for less than it costs you to make it. And so when I think about building a financial model for early stage company, for me, it comes down to forecasting on expenses. Forecasting on expenses is far more like valuable because it's something you can control. Something you have a much more degree of control and visibility into what your expenses are going to be. And the other reason is because, hold on 1 second. I'm going to close out of this screen share. So just so I can see the chat actually, honestly. So, and the other reason is because it's a plan or an indication of strategy. Meaning you can have and you create a cost budget. You're creating probably a detailed hiring plan for who you're looking to hire and a set of expenses beyond it. And that becomes a really great way to have a conversation with anybody about how you're actually going to grow the company. And so that expense budget becomes really the kind of core part to use and to kind of talk about a model, understanding growth. So that said, building a basic revenue model for someone to be able to play around with is usually a pretty valuable exercise in itself to understand like what kind of growth, what kind of numbers we have to get. I'm going to bring up an example of the SaaS model as a way to talk about the components of it. As I'm pulling it up, if anybody has any questions, feel free to hop in and ask. Let's see here. Okay, cool. How do I share this? It's funny. Yeah, Michael, your point to observe, I think, is a really good one, right? Because here we go, share screen. Because you can see what they care about. Actually, one of the worst things that I see is when someone like builds like a really, really, really detailed model is usually kind of a bad sign that they're over focusing on the things that don't matter.
You know, good with sharing your screen. We don't see it right now. You should just have to hub over.
Yeah,
hover over.
I know.
I just want to make sure.
No, we're good. Thank you.
Be a good host, which is a terrible role to be.
Nah, you're doing fine. So this is the SaaS. This is like the SaaS forecasting tool you can check out. So what I want to talk about is a couple like key components of modeling out like a SaaS company and the kind of core areas. And the way I outline the areas, it's growth, conversion, retention, revenues, and then cash, right? And so those I try to think like there's like 5 different kind of buckets. Now, so when I build out a forecast of a SaaS company, I care about growth, like how fast am I growing? Conversion, understanding whatever the channel aspect I'm growing, how fast am I converting them to subscribers or whatever the metric is. How fast might my retention work? So like once I acquire them, what does retention look like? And then revenues is a function of like basically retained subscribers. And then cash, because in SaaS, cash can vary from revenues. So in this model, like I use the SaaS forecasting tool as kind of like a minimal way to think about kind of modeling on a SaaS business. And so the way I tend to build the assumptions is such that we build out an assumption of like growth, right? And now this might vary depending upon the business model. So growth can either be an assumption of like net growth. Like the simplest way to do this is just assume subscribers, right? This is a buildup of like a channel conversion subscriber buildup. I could just build this up where I'm just assuming subscribers. I'm just assuming, hey, I have a certain number of total subscribers. I'm going to assume a growth rate in subscribers just grow it over time. And that's a 2-line forecast of a growth in subscribers that can be done very simply, and you'll assume growth that's like effectively net of churn effectively. And that's a very, 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 very simple way to do that. Kind of the next step up from that is to say, well, you know, I want to actually forecast out growth and conversion at the same time. Typically, the easiest way to do that is we'll do like a subscriber buildup. So meaning subscribers beginning a month, new subscribers, renewed subscribers, churn subscribers, subscribers end of month. That's kind of a core building block of a model. I break out not up for renewal in a couple areas to make it easier for some internal calculations. But the core part of this build is subscribers beginning a period, how many are new, how many are churned, how many do you have at the end of the period. And then from that, you basically calculate out the growth rate that comes from there. Usually when we do that, there's 2 things that we're assuming there. One is new subscribers. So we have to have some way to figure out how many new subscribers are entering in each period, something like this. And then conversion, how many of them are renewing and churning every period. So typically the way we'll do this is in a very, to do the growth part, usually we'll assume a couple like a growth channel, right? I set most of my models up so it's like pretty flexible, so you can determine the churn, the number, whatever you want to. But you usually define the growth as a function of, and we're growing new subscribers over time. Total growth will be the net of new growth and then minus churn. So now new growth we can do in a variety. There's many different ways we can do this. The simplest way is just to say, hey, I'm going to get a number of new subscribers. I'm going to get growth of new subscribers over time. One level up from that says, well, maybe I want to model out the activities that lead towards new subscribers, right? So perhaps would model out website sessions or leads or MQLs or whatever the metric that ties the operation of the business that we can control or that we're going to try to change or grow from. And so in this example, I'm doing a model of this idea of like new subscribers per period, but I could build one or many channels to say, here's all the different kind of channels that I'm assuming in terms of marketing spend or new growth or leads or SQLs or whatever they are, and model the growth of each channel at some sort of total of like new subscribers, for example.
Can I ask one question?
Yeah.
On this model that you're showing, so I see that where you have these assumptions where it's and there's a section that's like growth and churn assumptions in the subscribers, and it looks like those numbers are really are big and different. Like I see like sum and forth. Do you mind just like for 2 seconds like helping us understand like what column HR and how, you know, rows 22 to 31?
Oh yeah. So structurally the way I'm building this is I'm making a set of assumptions. And structurally the way I build models as a bit of a background is blue text, gray background, right? So blue text, gray background are inputs, Everything that's black is a number. It's a result of a calculation of a formula. And so in what I'm doing in here is I'm making an assumption, right? And I'm using that assumption across all time periods going forward. And in here, what I'm doing is these basically don't change because these are all assumptions. And so I'm taking the assumption that I assume I get started. I'm just assuming the same thing every period going forward. And then I'm using those to calculate each period. And the reason why I do that is because I want to create structurally a way for me to vary the assumption over time, right? So I'm assuming that my CAC is the same throughout all periods going forward. In reality, it's probably not, right? My CAC's probably going to change. My acquisition costs are probably going to increase over time, for example. So I build it this way so that on each period I can do the calculations. And it's very easy if I want to change the assumptions. The assumption changes over time going forward. This model is a simple model. It doesn't like build in pre-built ways to build in kind of changes in assumptions going forward. But that's the idea, like the structure for it. These columns themselves, they're just like they're reporting columns, sums.
Cool, thank you.
So this sum is just gonna this for example is just gonna sum all of just sum the total going across. And this is like the buildup where I do like this one reports the initial, there's the sum of all the changes in the period, and this is final. This is like a me thing, honestly. Not required any models, but I do it so that it's really easy to scan a set of numbers and see what the totals look like over the periods. Oftentimes we will just create like an annual set of annual numbers going across, or do all the numbers going across and sum them up at the end. I like to have a thing in kind of at the beginning, which allows me to easily scan the numbers to understand kind of the overall changes really quickly. So that's what that structurally means. And then this column just notes about kind of what's being done, or if there's a link to an article that explains kind of how it works or those sort of things. That's kind of how like a note structure works for that. So these are all assumptions. So you see they don't change over time. These are numbers that do change going forward. And each one of these, it's using the calculations internal to the model, or it's using the assumptions above to kind of calculate the changes over time. That's kind of basically how it works.
Thank you so much.
So for this example, I'm setting up some assumptions around average revenue, gross margin, and CAC, for example. Now, oftentimes people will often ask, like, how do I model out growth, right? So you can get really, really, really detailed in modeling on each. If you're doing a business where you're using a variety of like digital marketing channels, you can build out a model which models each of those specifically. Oftentimes not useful, right? Especially at this stage, because you don't really have like a detailed marketing plan to support it. So it's usually not the most like valuable way to do it. But as you kind of build more complexity and understanding into the business, you can add in more marketing channels to the degree of which, adding more detail to the model helps you make better decisions. For this model itself, I don't get it at all. I just assume a CAC, I assume a customer acquisition cost per new subscriber, and I assume a growth rate of new subscribers. And the reason why I'm doing this is because I'm calculating out the marketing costs as a function of growth. You could also do it the other way around. You could create a forecast of marketing spend going forward over time and how you're going to grow that, and then calculate out the number of new subscribers you get based on your assumption of CAC. The key is to make sure you do that. One of the common error I see in models all the time is people will assume their growth, and then they'll make an assumption of marketing spend, and you'll look at the model, and oftentimes the CAC, or the customer acquisition cost implied from that, is just wrong, right? It becomes oftentimes way small. Like these don't factor in for the cost of growth kind of later on the time periods. So I always like to make the two, like I like to make spend and growth combined. It's a personal preference in terms of like mechanically how you do it. The math is exactly the same, whether you assume spend and calculate out growth, or whether you assume growth and calculate spend. It's the same thing either way, so it doesn't really matter. But you can break them into like different channels as need be. B2B SaaS usually works a little bit differently. B2B SaaS, where there's a sales effort, usually will break out a full. I should pull out an example of this, but usually what we'll do is we'll detail out like sales hires. So actually call it like a sales hire schedule over time. Usually some assumption of like sales ramp, like how long it takes for them to become ramped, and then model out how many leads they can create per period, what the conversion rate for leads is, and then whatever aspects of the funnel that's kind of the company identifies as being important from the track, the conversion rate through each part of the funnel, all leading all the way to new subscribers. So that's the one variant to it. Now, again, you can also back into that. You could create a forecast of growth and new subscribers and then go back down the funnel the other way, like calculate it out. Mathematically, they're exactly the same. I think it's personal preference in terms of like somebody wants to assume and how they want to plan for the business, but either one can work. So in this model specifically, like, so once I have an idea of like growth, in this model, I'm not doing conversion. So growth, conversion, retention, revenues. I'm not doing a conversion thing, but usually if you're doing simply digital channels, you'd model out your growth, model your channels, you'll assume like a conversion rate. Now, most typically just assume a simple conversion rate per period. That's perfectly fine. There's ways to get more complicated with lags and other things, but usually not necessary for it, especially for kind of this purposes. Now, the key thing that I'm trying to capture in here is the idea of once we acquire them, what happens to them? So how many churn or renew per period? And I have like a basic assumption, on here, which is basically a churn rate. And I'm setting a contract cycle and a billing cycle. And especially for SaaS, this is like important to kind of understand the difference between them. One, because I want to model out contract churn, and two, I want to understand when they get billed. So I build basically two entirely separate schedules for that. For this subscriber buildup, I'm basically just doing churn. It's basically I'm using a formula to go back and see, okay, well, for every new subscriber, let me go back and however long I have to go back in terms of whether it's a monthly contract or an annual contract or whatever it is, go back 1 month, 1 year, churn off a certain percentage of them, plus go back to whoever's renewed. So I break out the subscribers into new and renewed. So that way I can always look at the renewal cycle and the new cycle and get them on the same cycle and calculate churn based on when they renew or based upon when they're renewed. So once I figure out kind of churn, then getting to subscribers ended period is pretty straightforward. Now, the reason why it's important to do both a billing cycle and a contract cycle for SaaS is because oftentimes recognized revenues don't match up with when things are actually get billed. And so in most of these, I assume, a contract cycle, billing cycle can be separate. So I could assume like a 12-month contract and something gets billed 12 months up front. I can assume a 12-month contract where someone gets billed per month. I can assume a 12-month contract where they pay quarterly, for example. And so I construct it so that it's flexible in that regard. So I'm going to play with kind of different payment mechanisms. So, but the important thing here is that I want to calculate out revenues. Basically, recognized revenues is whatever the average revenue per subscriber is times the number of subs. Billings becomes different because I'll look to see what the actual renewals are forecasted from it, times the average revenue to figure out times the length of the billing cycle to calculate the billings, the cash that comes in each period. And what I'm always doing as part of that is this basic kind of revenue build, which I'm calculating here deferred revenues, which is capturing the difference between revenues and cash that's collected during the period. Usually like a full model, something like the runway tool. Typically, I have a section which does like deferred revenues, and I'll say what was deferred revenues at the beginning of the period, or what was basically cash that I've collected that I haven't been able to bill as I haven't been able to recognize as revenues yet. What was deferred revenue beginning of the period? How much cash did I bring in billings? How much revenues how much revenues I recognize that period? What was deferred revenue end of period? And so that's kind of the core build that helps me have an understanding of cash as well as revenues from that. The other part that's usually important kind of once we have that is like MRR. People always want to understand MRR and ARR, the important metrics from it. For most SaaS businesses, I know MRR isn't SaaS, but for most SaaS businesses, we can think of it as the same. And so when you're actually kind of really managing and running a business, they're not the same. There can be differences in them. But for forecasting purposes like this, we can usually assume they're pretty similar. And usually when you're doing like an MRR build, you want to do the same idea. Beginning MRR, new MRR you add during the period, what kind of churns in the period, what's ending MRR. And you can use that to calculate ARR, ARR, annual recurring revenue, all sort of metrics from that. So like if you always break down the modeling of the SaaS business from growth, conversion, retention, revenues, and cash, then you can, those are like the core like building blocks of like building a SaaS model, and then you can vary each component kind of based upon like whatever is like really valuable and necessary for your particular business. Before I go any further, what examples or questions would be helpful for me to cover people to help challenges or things that they're kind of doing in their models or thinking about their businesses? What can I help with?
That's a great question. Let's pull the audience. Hey guys, is there anything that like you would particularly like help with, or any questions you have, or anything else? Just write them in the chat. Hello.
I will. You have to give time. Takes time to type things. Enterprise SaaS tends to be a little different.
Yeah.
You know, when I do enterprise SaaS style businesses, I tend to model a little bit differently, or I model each individual contract. One of the main issues with a lot modeling SaaS and B2B SaaS in general is how detailed to get.
Yeah.
Because oftentimes you'll have different products lines, different business segments, different business models, and it's kind of like how detailed do you get down to that? I always try to say like start by being as simple as possible. It's really easy to get way too detailed. Can
I ask you a question? So for B2C, right? Like just high level, you talked a lot about kind of like, I don't know, opening number of customers, new, retain, churn, right? Is there like, what are the top level things that you would look at if you were thinking about like B2C, like how would the model change? I assume it's still CAC. I assume it's still growth and the subscriber, right? It's just that there's less of a delay in payment and liquidity, like you're doing with deferred revenue, et cetera.
Well, I mean, with most consumer SaaS, the structure is basically the same.
Yeah.
There's two things that come up. One, I would say, is it's very common that a company will say, I want to have an annual plan and a monthly plan. Mm-hmm. So there's two ways to do that. Either just assume you just assume the average, right? You just assume the average and not worry about it, not model the details out. Mm-hmm. Or you build one section for monthly, one section for annual, and combine the two of them to model each one separately. Important for understanding cash flows, right? Mm-hmm. The other aspect that comes up is around churn. And the thing about churn is, especially for a lot of consumer style apps, games apps is a perfect example of this. Churn is often a function of, how long a person's been a subscriber, right? So high churn early on, and then churn kind of goes down. The longer someone's been using a service, the decreasing likelihood they're probably going to churn. And so usually creates a churn curve, something like that. And so a model like this is going to assume the same churn for all subscribers every period. It doesn't treat them separately. Now, you don't have to do it that way, right? Let me show you an example where it's a little bit differently.
Yeah, and that's great. And then we also have our first question from Akil at UPage. Any advice on how to create a model? Yeah, do your thing first, and then I'll bring up this question.
So what often happens in the churn, I'll kind of show a little difference, is when in a model like this, or we just assume churn, we're applying the same churn to everything else. To get a little more detailed in it for apps and games, we typically have to do something we do like a cohort type style analysis. And we see cohort data all the time in our apps and our data platforms. They create cohort analysis. We're creating, if we want to get really detailed about it, we use a going forward cohort analysis to do the same sort of thing, which basically says, hey, let's treat every month's new subscribers separately and look at their churn separately over time. Because usually what that does is, we'll see something like, this is like a unit economics tool. I'm trying to understand what the unit economics is of a single subscriber, user, customer, whatever, over time. And so for this example, this is what you're seeing here is I'm making some assumptions around revenues and costs and growth. And this is the green thing is basically billings per period. And this red dotted line is just cumulative cash flow, right, over time. So $20 per month looks great. I can start putting in some cost of sales and those sort of things. I can also account for like different billing cycles. So the cash will come in at different times. But what's important from it is churn. So if I start assuming 5% churn, well, this changes a lot. Let's see, let's choose a little lower to maybe see a little bit differently. So you can kind of, I'm just trying to adjust the graph so the numbers become a little makes much more sense. But what you can kind of see here is this this green line kind of goes down over time, and it reflects the ongoing churn over time. So sometimes what we'll do is we'll create a forecast like this for a single subscriber to show what it looks like over time, and then use that to generate a forecast of across all the cohorts and things going forward. But it's something that doesn't necessarily get more necessarily useful for this stage, but doing that sort of cohort style forecasting can be really important for consumer style things that oftentimes have higher churn rates and acquisition strategies that incur lots of churn. And the reason why that matters is because churn becomes an important thing to model understanding growth to make sure we properly account for the full cost of growth. If you're just assuming a growth that doesn't include any churn, you're probably massively underestimating the actual kind of expense of growth. So that's why it kind of matters from that perspective. That's the consumer.
So question from Akil, who's from UPage, which is building an all-encompassing online SMB digital business platform. He said, any advice or tips on how to create a model that allows changes on a monthly basis? Would you keep your variables on a separate sheet or what?
Well, yeah. I mean, this model does that, right? So,
but what if you think that churn is changing month to month? I think is what he's saying, right? You have an initial churn that's higher, and then it starts to come on down.
Okay, so two aspects of that. If you thought churn applied to all subscribers, this model here already does that. If you thought churn changed as a function of how long somebody was a subscriber, then you would do a cohort style approach to it, right? And typically what you do for that is, so the first assumption is pretty easy. Even this structure theory, for example, I assume a churn rate, 5% churn rate. And I'm assuming on the forecast sheet, I have a churn rate which is 5% going across. That doesn't have to be, right? This churn calculation is basically doing some math to go back to find kind of previous ones. But basically, it's always going back to the churn rate. Say, hey, I'm trying to figure out how many people I should think could potentially churn, and then I'm timesing by the churn rate, right? Now, I don't have to assume this same churn rate over time. I can just change this. Maybe it goes down to 3.5. Maybe it goes down to 3. Maybe it goes down to 2. So I can change this. I can create any rationale. I can create different structures or assumptions or rationale in terms of why I may want to reduce that churn over time. Now, structurally, this is going to assume that your churn applies to all subscribers, independent of how long they've been with you, independent of anything. You're saying your underlying churn rate for all subscribers is going down. The other way of doing it is assuming that churn is a function of how long someone's been a subscriber, and then creating a cohort buildup, which basically models out the churn of each month separately, basically, and then you just add them all up as the total. Yeah. But that is something I pre-built into some stuff, but it also gets really overcomplicated for this use case.
I believe it. Okay, awesome. All right, well, let's keep going. What else?
Well, I would love to go over other questions that people may have. I can talk about any aspects of the model and stuff out there, but especially since we don't have a lot of people, it'd be fun to just answer specific questions.
Yeah, does anybody have any specific questions about their business, things they've encountered, how to manage Taylor's models, other things that are on your mind? I'll really take any question. What is that noise in my background? That's my dog having a nightmare right now. Inopportune timing. Just throw them in the chat if you have any questions. Okay. And so just like tactically, right? When you're doing this and you're doing overrides, what's the best practice that you have for people to kind of version what you're doing, right? Or understand the where they put in I also find that when I do a model, I'll put in a manual input and then I'll completely forget that it was a manual input.
Yeah, that's a good question. I mean,
Yeah,
in general, one of the problems with the models is that we build them for specific things, and then we build them for like our specific use case for a thing we had to solve at that point in time. And we don't think to make when we don't usually have to do this, but we don't have to make it so like it's universally understood to be used by other people easily at any point in time, right? So that's like kind of the difference there. So to solve that gap, we usually try to solve it through like structure and formatting is the first thing, and then notes, right? So one on formatting wise, just making it really clear, like you make separating inputs and outputs, both in terms of formatting and structuring. So formatting is a common convention is blue text for an assumption, black for an output. Sometimes people use like a green format for interlinking things, although I think it's a little unnecessary. I use a gray text and gray background and blue text just because I want things to stand out a bit more. But using formatting, labeling like that to kind of point out where things are, number one. Two is structurally not doing that, right? Building out structure so that assumptions are separated from calculations, and being really crystal clear. You are making edits manually into like a cell where everything else is a calculation, being really super like obvious and clear about it so you can understand it. And then and then notes is an important part to it where like I usually have like a notes column. And the notes column is where I can explain things. Like I use a notes column myself all the time. I'll explain the rationale behind how something's being calculated, so that then I can go back and like if I'm coming back to a calculation months later, I can be like, okay, here's what I was trying to accomplish. So it's kind of like writing code in the same way, right? Like there's standard ways to write code and easily format understood ways. So follow the same thing, and then use notes and comments in line to kind of provide context to yourself or to other people to understand it. The general convention we try to do is we try to like separate inputs, calculations, and presentation, right? So have one place where you have inputs, have one place where you have all the calculations, and have one place where you have all the important outputs. And when you're presenting something to someone like Will, like you for example, don't make you forced to dive into calculations, right? Make a place where it's easy to see what the inputs are. Make a place where it's easy to see the outputs, and put the calculation somewhere else, right? So that way, the way I think about the model is it's a set of calculations, but it's also hopefully like a story or a narrative towards what you're doing. So my thing about that is don't hide your narrative. Like don't make your narrative like line 60 on a certain sheet to show, oh, like revenues are going up. Like don't do that. Make a separate sheet and make a chart which says revenues. Like don't force someone to pull out the things that they want to understand from the model. Make it really simple, super crystal clear. In most of my models, I usually have a sheet called something called key reports. And key reports is basically the charts that I think are most important for someone to understand. There's a reason why the first one here is burn and cash, right? Cash balance over time, burn per period, because I want someone to be able to open the model and say, oh, I understand what your cash balance is over time. Does it make sense? This will reflect, net losses, when you turn to positive. It will reflect like funding rounds coming in, all those sort of things. And so like that's like super important. And then revenues, net income, cash flows, expenses by category, those sort of things. And so, that's one way in which you surface information in a way it's easy to understand. So you don't force someone to have to dive in to kind of understand all the parts to it. Also, it's easy because you never really, it's never fun to get into conversations around specific formulas and calculations. So don't force someone to do that, right? Highlight the things you want someone to take away from a model, like on a sheet, which says, hey, here's the key things. Look at this. And then if you want to get the rest of the stuff, fine. But, don't force someone to dive into that stuff to figure out the story of what you're trying to do. Tell them the same way. I think it's kind of like a decks. You make a presentation, a deck, the whole thing. Some people go through a deck and read the whole thing just by reading the headlines, and then they can dig into the content if they want, beyond that if they want to. It's probably simple decks to begin with. Same thing with models. Don't force someone to dive into all the details. Have us all like supporting context and information, but have like a couple like really crisp, clear things you want to do. Usually the best way to do it is through like charts.
Can I ask just a follow-up question? So like, okay, I put in everything. I think like, what should I look out for, and how should I present things? I think you just told me a little bit about how to present things, right? Like making sure that you probably have some combination of the basic charts and the key charts that you think are important to your business or present your value proposition, right? Or what's great, right? But how do I also kind of like look at the mechanics of my model and say like, ooh, this looks bad, this looks good, maybe I should think about this, right? Like how do I use it to kind of understand my future in my business?
So the first things, so one of the first things I always look for is just understand cash. Because so especially for like this early stage, I want to understand just like cash balance, how I expect it over time. What I look at is expenses and the components of the expenses, meaning is someone kind of clearly outlining the types of expenses they have, and do they fit kind of what I think is going to be there? Meaning, are they spending all their money on salaries, or are they spending all their money on growth? And do I think that reflects the best strategy for the business given the stage they're at? If they're doing like detailed revenue forecasts, I'll go into some like the specifics, like do I think that these churn ratios, whatever, makes sense? But usually what I'll do is I'll focus on like revenue. Okay, a better way to answer that is I'll look for like revenues. So someone can create like a growth of like revenues going forward. And what I try to think about is, okay, well, does it make sense, right? What is the, meaning usually something like this. So usually have a growth in revenues. And I'll try to think like, okay, does that make sense? Do I think you can actually get a 5x growth from like this year to this? By year 3 or 5 is at that level of revenues. Are margins changing, right? Is there some changing in terms of SG&A margins or COGS margins, or SG&A margins getting way out of line? So it's usually the idea of like top line growth in terms of like margins to say like, do I think someone's properly accounting for or properly thinking about the size of the business they could get to, but then are they accounting for the margins appropriately as well, change over time?
Okay.
Those are the first things I kind of focus on usually. The one thing that comes up oftentimes in models is like I think I always check for is like marketing growth. I touched on this like briefly a little bit earlier, but I want to make sure if someone's properly accounted for the cost of growth, right? Whether they're properly accounting for cost of salespeople or probably accounting for like digital marketing expenses, those sort of things. People very, very often build a model where they build a forecast of growth that's separate from their forecast of spend, and their CAC may not make sense over time. But maybe you may start off like a $10 CAC, and the CAC goes down like 1 cent later on. And I think it's probably wrong. It probably goes up over time, not decreases to basically zero. So it's a common error I see a lot, so I check for it a lot.
Oh yeah, those are great. I also totally agree. Generally, especially when it's paid advertising, that CAC's going to go up. But are there any other like kind of like interesting, like you're saying, like common issues or errors like that where people don't adequately forecast their CAC increasing?
I mean, I would say people often don't account for the true cost of growth. But most in SaaS, like we think if there's only cost to acquire, there's usually a cost to retain as well. Customer support, customer retention costs, continued remarketing to customers. Are we properly accounting for like that as a cost? Especially in like sales driven, or do we have enough costs for customer success, customer support? Those areas is the thing I kind of see a lot in SaaS. Like you'll see SaaS margins like 99%. It's like, well, probably not accounting for customer support. Maybe it's being misclassified. I don't worry about the accounting side too much. Like whether someone's appropriately accounting for something as COGS versus SG&A. I think at this level it doesn't really matter. That's like an accounting distinction. It doesn't affect cash. So like I don't usually care about it. But are they properly accounting for the cost to like support and grow the product? That's usually like the most important thing.
Any other key metrics or things to look at? I know you said basically cash flow. So you're talking about CAC. I assume like where can I get LTV out of here? How is that a good one?
Yeah, so that's a good point, right? So LTV, CAC, LTV to CAC are common metrics to understand. The thing about LTV is we don't have to create a forecast. We don't always have to create like a forecast to do LTV. LTV, you can take your basic LTV is going to reflect. So like some people will create a forecast and they'll calculate LTV based upon all the kind of future revenue numbers. Really, like LTV is kind of like a forecast of like future revenues from every new quarter, new customers. And so like I'll use a tool like this tool to calculate LTV, because I'll say, hey, for like one customer, what do the cash flows look like this customer going forward? And I'll use it to calculate LTV. And a model like this, you can't calculate LTV from like the revenues going forward. It doesn't make sense the same way. So I'll try to use the metrics that are built in around churn, customer lifetime, those things to calculate LTV. And you notice in this case, I'm calculating expected LTV for all customers that are added per period, right? So I'm using it is a very, very, very basic, simple method of calculating LTV that's using the simple metrics that are like assumed from the assumptions here around revenue per subscriber, per churn, gross margin to calculate CAC. LTV. This method here is going to be a little more detailed because I'm accounting for changing churn over time. I'm accounting for changing margins over time. So there's more complicated ways to do it. But you can usually start with like a simple estimate of, or a simple forecast of LTV, just by using your basic assumptions around average revenue, margin, and churn.
Okay. Follow-up question. So I know that you, and I agree with you, that like you don't have, there's a balance between like focusing on precision and like signal, I would say, right?
Yeah.
And so how do you incorporate though the idea of like sensitivity or different scenarios, or if something were to go wrong or something to go differently when you're modeling?
That's a good point. So thank you for bringing it out, Will. So scenarios are actually interesting. There's multiple ways to do this. The simplest way people do scenarios is they create 3 different versions of the model, right? So you create 3 different instances of the model. One's best, worst, medium, and they make assumptions that are better or worse in both cases. That's a simple way to build a scenario-based model where you'll have your key assumptions around, for example, you have your key assumption around what your average revenue is, or what your margin is, what your CAC is, and you make different assumptions for each case and create a different kind of forecast from it. That's one way to do it. Another way to do it is use like a scenario tool, like a scenario-based add-in, for example. And that what it'll do is you can usually assume like a range, right? So you can say, okay, I don't know if CAC's going to be 10 or 20. I'm going to assume a range from 5 to 20, and the model then calculate like distributions of expected like revenues and those sort of things. Or you can create specific scenarios. There's also like a wider range of like web app tools now to do modeling that also are basically pre-built to do a lot of scenario analysis. Pry, Finmark, Causal, all these ones are web tools to do forecasting in general. And one thing pre-built into all of them is the ability to do like scenario analysis. So they can easily create scenario-based, range-based outcomes based upon that. Causal, for example, I don't know if anyone's used it before, but causal.app, it's automatically pre-built to do range-based forecasts. So you can make an assumption, which is you can, instead of like making an assumption of what the growth rate is 10%, you can say growth rate is 5 to 20%. You can type it in just like that. And then it'll create a forecast of it'll create outcome forecast of growth or revenues, those sort of things. And it'll create effectively a probability distribution. It'll say, well, then I think, in X percentage, based on this assumption, X percent of the time it's gonna be this, it's this. It gives you an idea like the range is part of it. So, that's a kind of a long way of saying that there's the simple, like a couple of static scenario outputs, and then there's more automatic range-based ways to do it. Depending upon your familiarity with the different tools.
Yeah, I've seen Tactic and Causal.
Yeah. I've used Tactic a number of times. Tactic, I'm using a lot more lately for modeling funds, right, than modeling kind of companies.
Yeah, that's their new thing. Yeah.
But it does a lot of the same things. And just to call it biases, like I'm an investor in Causal, so that's a bias I have there. I know CEO Tactic well and use it all the time, so I'm familiar with both.
Okay, super cool. All right, so in the last couple minutes, if there are any points you want to hammer home, anything you can tell us about, hey, if we want to learn more, or things to check out, resources of yours, or how to get in touch, etc.
Yeah, I don't have anything further to say. Like, this is one of those topics I know where it can be hard to get into some of the details of everything. Meaning, like, it's like learning how to code in like 50 minutes. And so I recognize that the details and the components of it can be pretty hard. What I hope to do is provide an overview to like the major areas to kind of understand, and then links to resources and tools to kind of understand more. All the models you saw I shared they're free. You can download them from my website. And also you can email me anytime, ask questions about these tools or any other web app tools out there about how to build models. So I'm happy to help. I work with hundreds of companies a year, and I'm happy to help any point in time.
Awesome. All right. Well, unless anybody has any questions or anything else, I think that's great. I just put I put Causal's website in the chat and your website. And this is awesome. I really appreciate it. And thank you so much.
Thank you.
try to end this. God knows how that will work. Thank you, Taylor. All the best.
Thank you.